Hi guys, it's Craig from WealthHealth here, and today I'm going to be sharing a few tips on how you can make yourself look more attractive to a bank so that when the time comes for you to apply for some finance, that there's a greater chance of having a more successful outcome. So one of the things that the banks look at is how well are you managing your money right now. So the way that they find that out is they have a look at the bank statements that are submitted with your application. They're wanting to make sure that there aren't any dishonoured payments coming out, so that they know that you're actually paying attention to your finances and you're just generally being responsible. And the same thing goes with any debt statements that you have, such as credit card statements and personal loan statements. They're wanting to see that you're actually paying those on time, not a few days later. And it's also not okay, as far as the banks are concerned, to allow an account to go overdrawn just because you might have some money in a different account. They want to ensure that that's transferred over before you spend that money. So all you're doing is these people who are looking at your application have never met you before, and the only thing that they've got to go on is how much deposit you have, how much income you've got, if your credit history is okay, and how do you actually manage your money right now. And those things together is going to enable them to build a picture about what type of person you are and whether you're going to be appropriate for them to lend money to, so that they can actually get it back for their investors in the future without having to chase you up or sell your house. Another one is the banks actually do look at, we ask you how much do you spend on food and how much you spend on power and petrol and core household expenses, and that might even include childcare and that sort of thing. What the bank's doing there is that they're actually trying to understand that you can actually afford those mortgage repayments, even if that mortgage interest rate went up to 3 to 7.5% in some cases. If interest rates went up, will this person still be able to afford the loan that we're giving them, or are we actually going to put these people into an adverse financial situation by approving this loan? So they do look at affordability, they do look at how you're spending. A friend of mine actually recently told me that he was having a conversation with his brother. They're both going for a loan, and one of them was saying, I don't know how it's going to look. I've spent all my money on McDonald's this week, to the bank. Actually, what happens is the bank they are starting to have a look at stuff like that. They're looking at how does this person go about taking care of these very human needs. Identifying that a lot of people do rely on eating out and not necessarily cooking these days because we're just so busy and can't be bothered doing any dishes, I don't know, whatever it is. But they do look at that sort of stuff. However, we can overlay that by saying, look, these guys are in this situation. Obviously, they do have the choice about how they spend their money. So there are some expenses that people don't have a choice over, like your basic living costs, like how much petrol are you using, how much power are you using, what's your rent, and all that sort of stuff. But when it comes to other things like food, they choose to go out because they can, there's the money, they're eating, compared with when we actually do have a financial commitment such as this, we are going to be able to make that choice about how we spend that money. So one of the things that the bank's going to look at is how much other types of debt you have, including any overdrafts, credit cards, personal loans, vehicle finance, gem visas, Harvey Normans or whatever's. What we find often is that people might have on a credit card or a gem visa, for instance, they might have an available credit, or they might be able to borrow up to $15,000, for example. However, their debt's only around about that $2,000 level or $1,000, or maybe no debt at all. What the bank does with that is they say, effectively, if this person gets into a tight financial situation and they maxed out all of their different facilities that they have, will they still be able to afford this home loan repayment? So they just assume that you're going to pull at any available credit that you can just to keep everything ticking over. So sometimes what we recommend to clients is actually reducing credit limits when we put an application through. Another recommendation we have for some clients is if they do have a few different debts around the place that they've ticked up over a few years, sometimes we organise a debt consolidation loan for that first to sync it all up into one nice, low, easy payment, and then document that out over a period of time that might be suitable to meet the lending criteria of the bank for the home loan. We do that too. If there were 3 things that I could say to you about getting yourself presentable for a bank, 1 is have a decent deposit, 2 is make sure that you're paying your bills on time, and 3, don't get into any unnecessary credit debt. For any other further solutions around that, please just get in touch and we'll go through your individual situation. So if you're thinking about buying a home or an investment property, we would love to hear from you. Let's get in touch. There's the link below and we're going to figure out your next plan of attack. There's also an 0800 number around here somewhere.